Hi, guys, and welcome to this new lesson, a new reading which has been introduced by the CFA curriculum in the CFA 2023 syllabus. And it's a very, very easy reading if you actually look at the contents and the learning outcomes. And majorly, this has been introduced because of this wide variety of companies which come and the startup culture which has been, in place since a couple of, decades now, since a lot of startups have come into the business structure, including and actually resulting in a lot of private equity investments. So I suppose that was the thought behind actually introducing corporate structure and ownership, so that you understand how business is structured, and not necessarily every company is a corporation, and neither is every company in the form of a proprietorship, right? And so that you understand the various pros and cons of these structures, at least from an investment angle, that might make sense. So let's get started with first looking at the various learning outcomes which have been mentioned. And these are very simple learning outcome statements, starting with comparing business structures and describing key features of corporate issuers. Now, this, if you're coming from a graduation background, I suppose you must have already, and specifically commerce graduation or an MBA background, then you must have already understood various structures like LLP, general partnership, cooperation, proprietorship, right? So that might be just a little bit redundant for you. Nevertheless, we have tried to incorporate some case studies which might make this interesting, right? Then we go into the second LOS, which speaks about comparing public and private companies. Okay, so then we are just looking at an angle of how, what are the ownership rights differentiation between public and private. And finally, we ended up with comparing the financial claims and motivations of various stakeholders in the entire system of operating a business. Right? So let's get started with the first LOS, and we discussed first the areas of focus in the entire, comparing structure of various business structures. So first is, we also always want to understand the legal relationship. Now, when I say legal relationship, it might sound very academic. So I'm trying to make it a little more interesting for you to understand this. When we say legal relationship, we also mean liability. Okay. So if, for example, I have an LLP, which is a limited liability partnership, versus I always have the option of, starting a business on my name, which is the sole proprietor, right? So you might say that what's the difference between, now if you try to interpret this from a academic angle, you might say that okay, it's limited by liability, and in sole proprietor I am taking all the calls. But in the practical sense, in the industry, it has a big difference, right? Because when I'm talking about sole proprietorship, and if there are any suits which are instilled against me, if they're initiated against me as a sole proprietor, then all my assets behind are also going to be a part of that. That means my house, my cash reserves, everything comes uh, in the picture of the suit, right? Whereas in LLP, it's got a separate legal entity, right? That means it's got a different PAN, which is nothing but a permanent account number. When we are speaking about India specifically, you might, in your area of region, you might also have something called as the TAN number, right? So that's what we are talking in terms of legal relationship. Okay. Now the owner and the operator relationship, I felt that the curriculum has tried to make this a little more generic than actually what it is in the real world. But nevertheless, we will still try to discuss on how things are a little different. Right? Business liability is a very interesting aspect of various structures, and we will get into it. And then finally, taxation, which also will be pretty different. There are pros and cons of it. Again, the curriculum has tried to make it very generic, whereas the reality is a little more different, right? But I will try to come up with certain anecdotes in which I feel that okay, this is what is happening in the real world, right? So just to try to make it a little more real. Simple table, rather than taking you through various structures, various paragraphs of readings which are mentioned in the curriculum. I have directly compared this so that it becomes a little more easier to understand. Okay, so if we talk about the legal relationship, the sole proprietor, right, is the same as and there's no difference between the proprietor and the business. Okay, legally speaking, in terms of taxation as well as liability, or in any other matter, right? So there's no different PAN account number or a tax identification number which is used in case of a sole proprietorship, and is perfectly fine to start a business as a sole proprietor. Operations, well, it doesn't mean, now this is what the CFA curriculum says, that it says that it's owner operated. Well, it's not really necessary to classify that, and would be a little more generic. In the real world, you could just employ as many people as, probably in a general partnership or even an LLP or a corporation, and it could still be owner cooperative, right? So owner operated, I felt, is a little more generic term, probably doesn't even make sense, right? It depends upon how the business culture is. Now, it can differ, right? So let's talk about business liability, right? So I'm not talking about operations. I mean, you can really try to understand that by yourself. The only difference, if I want to point out, is that in case of public company, okay, that's where it makes a big difference, because in a private company, the sole proprietor, the founder of the business, without any other equity investments done by any other investor, could function exactly like a sole proprietor. That's how it's happening, right? And there is also a concept of a one-man company, right? So, for example, in India, if you want to start a company, you can start a one-man company as well, as probably the minimum requirements of having two people, right? So let's look at the taxation, business liability side. So in case of business liability, the liability is unlimited, that is what is more important. Okay, it's unlimited to the assets of the sole proprietor. So you started a business, there's a suit which happened against you. Let's say in case of indirect taxation or direct taxation, then all your assets can be used to pay off the debt, and that's where it becomes a little more riskier to keep all your assets in your own name. It's much better to probably keep it in LLP structure, or probably in a company structure, or maybe just try to divide the assets across your family members, right? Uh, the general partnership is actually nothing different than a sole proprietor in terms of the liability. The only thing is, now, if let's say you were the only proprietor in the business, now you got your wife along to do the business. Now the liability is just divided across two people, but it doesn't mean to say that the liability is limited. The liability is still unlimited for both the partners, right? In case of a limited partnership, okay, so now this is not an LLP as per the CFA curriculum. They're talking about a limited partnership. So again, there is no different PAN in case of a limited partnership, and there's no PAN in case of a general partnership. So that means there is a PAN, but the liability extends to the partners themselves. So if you talk about the taxation in case of general partnership and a limited partnership, the taxation is same, right? However, what the CFA curriculum does not mention is also a structure called as the LLP. Okay, so limited liability partnership is much more useful, and it's almost similar to a company, except for the matter that it is in the partnership agreement. Okay, instead of a company in which you've got shareholders, in case of a limited liability partnership, you've got partners. All right, so there's a general partner, and or easier term would be managing partner, and then you've got your limited partners who operate as probably as a dormant partner. They might have different function in the business, right? Now in LLP as well as company, the identity is pretty different. So if this has got its own PAN, if you're talking about India, and in other countries you might also have a tax identification number, which is same, right? So that means the liability is limited to this entity itself, and the liability would not come to my personal assets. Okay. Now, financing by partners and partner finance. Okay, we understand this. What CFA Institute is actually trying to say is that it's trying to make again a very generic comment, which I really didn't like. The fact that the sole proprietor business can only be self-financed. It's not really so. You can also get into separate agreements wherein you can also raise money in terms of general partnership also, and also limited partnership. The only idea which I think CFA curriculum could have made it more clear is the fact that Loan on these partnerships is not possible. Okay, that means I cannot take my general partnership and take it to let's say a bank and say that okay, you fund this, which also in India sometimes, if your partnership balance sheet, income statement, cash flow is pretty strong, then you might still get that financing. But again, the financing will be done on the partners, not on the company, because there's no separate legal entity, right? Whereas in LLP, you can actually get funding for the LLP itself, okay, based on the credibility of the LLP. So if the income statement, the balance sheet, and the years of operations of the business is pretty strong, you might get the funding for the LLP itself, with the partner or the general partner being the guarantor, or maybe even some collateral being used against the LLP. So you need to understand this very clear, right? Because there's a separate legal entity, and hence the bank can provide funding for LLP. And in case of any default of the LLP, the personal assets of the general partner don't get used. Okay, that's the catch here. Okay, uh, now obviously, and by the way, in case of LLP, you can also raise equity. The only difference will be in case of raising equity. In case of a company, you give them a share. In case of limited liability partnership, I'm not talking about limited partnership. I'm talking about LLP. You will be giving a partnership stake, and the partnership stake can be as low as 0.5% as well. Okay, so if in case you are starting a business, right, and you don't want to be in this unlimited liability scene of partnership structures, and you want a separate identity, probably the LLP structure is much better than the company, because the difference between an LLP versus a company is the fact that the amount of regulations which increase between these two is too high. So the cost of bearing those regulations is just an expense that probably is unfound, right? So hence, a lot of chartered accountants will suggest that if in case you're starting off the company now, and it's just a start, and maybe you are under 5 or 6 people, but you want a separate legal entity, LLP would be a better structure to start with rather than the company structure. You might eventually even convert the LLP or make a company which holds the LLP and dissolve the LLP at the end, which will work fine, right? And the investors also would prefer either the LLP structure or the company structure. Investors generally would not be very keen on your general partnership, limited partnership, or sole proprietorship, because they can't fund it. There's no separate legal entity, and legal cost is very limited. All right. So that's how the structure is in terms of comparing the various structure. Right. Now let's try to look at specific types of companies. Now we are not talking about we understood the basic difference between various business structures. Now let's talk about different kinds of corporation. Corporation is nothing but another term to a company. Okay. Now we can ideally try to divide this as per the objective of any corporation. Right? It can be public for profit, private for profit, or non-profit. Non-profit is pretty straightforward. You can have NGOs, right? You can have education, companies made specifically. I mean, for example, the CFA Institute itself is a corporation, but is for non-profit, right? So please be aware that when we say public versus private, it doesn't mean that we're talking about government companies. Okay, that is a different definition altogether. But when we're saying public, we're saying the literal word, we are using it for the distinction, which is large number of shareholders. So if, for example, in the international convention, any number of people more than 50, okay, 50 investors, if you have more than 50 investors in a company, you would automatically be categorized as a public company, irrespective of whether you have been listed on a stock exchange or not. That's irrelevant, right? And private is if there's less than 50. That's a general convention, and it might differ basis country to country and the taxation laws and the company laws which are there, right? Let's try to compare a little further on what is the distinction between public versus private. And I've actually used a proper variation, the distinction as per the accounting system in India, which might be very similar to what you might be having in your country as well. But I use this as opposed to what the CFA curriculum is given, because it's more logical to discuss this in terms of the regulation, right? So when we're saying private company, we are saying owned and traded privately, which means, it's the number of shareholders are lesser, right? When we're talking about public company, we're saying more than 20 shareholders, which we already spoke about. And as you can see out here, the minimum requirement to start a company is two people. So that means you cannot start a normal private limited company except of two members, which you need, which is also the similar requirement for LLP as well. For LLP also you need two people, because how can you start, when you're saying company, it means you have company, right? And you cannot start a company without people, except there is a clause in which there are also a one person company system in which you can still start without the extra partner, right? The maximum number, as you can see out here in India, is 200. That means in case of when you're talking about a private limited company, in a private structure you can have more than 200, right? And as you can see in the previous international convention says somewhere around 20. If you have more than 20 investors maximum, or members, if you want to use that word, then you are a public limited company, right? So please do understand, exchange requirements is not really necessary to be the eligibility in terms of private versus public, right? Minimum capital required for a private company is 1 lakh. Okay. Again, this is where even the LLP structure makes more sense, because LLP just requires 50,000, right? So you can see how the LLP structure is very similar to a private limited company in terms of all the requirements, but it just makes things a little easier, right? When you talk about a public limited company, you need just 5 lakh rupees. The number of directors you require in a private limited company is 2 directors. The maximum and the minimum in a public limited company is 3. Suffix is pretty simple, right? Issue prospectus in case of private limited is not required, because you're not trying to get more investors, hence it's not really necessary. Public company, it's obligatory if in terms of raising capital, because how will people come to know about your business? How can they understand everything about your business unless and until you have a prospectus? And that's what happens when you're trying to go public in terms of the IPO route, right? The minimum subscription, the company can allot shares without obtaining minimum subscription. That's pretty fair. I mean, it's arbitrary. The company cannot allocate shares unless the minimum subscription stated in the prospectus is obtained, right? What this is trying to say is that when we're going with an IPO structure, there is certain regulation in terms of the minimum subscription, which has to be stated in prospectus and has to be followed. And that mandate is actually not there with the private company. Okay. Transferability of shares, not freely transferable, as there is no restrictions on AOA. Well, what it's trying to say is that if, let's say, I am an investor in a private company and I want to sell my shares, it's not as easy as probably a public limited company, because I can just go into the exchange and I can just sell off my shares to some other investors, which is there. In case of a private company, that would mean to find another private equity investor, right? Minimum quorum at the AGM required is 2 members, and in case of a public limited, you need at least 5 people to be present. Managerial remuneration, there are no restrictions in case of private company. In public company, there is a restriction of about 11%. I'll also add a little more extra information out here. In case of an LLP in India, the managerial or the partner's compensation basis, whatever shares you're holding, cannot exceed 60% of the profits. Okay. And when we say profits, you're talking about PBT. So that means if, let's say, we started an LLP and let's say we have first partner and the second partner, and let's say this is the main partner. When I say main, he is the managing partner who will be managing the business, and this is, let's say, a limited partner. And let's say this person holds 60% in the partnership, and let's say B holds 40% in the partnership. And now let's say in a given year, the profit is, let's say, 100,000. Okay, just for the sake of calculation. So that means, and we're talking about PBT. Okay, so that means at any given point in time, the total compensation for the partners cannot exceed 60,000. Okay, and out of that 60,000, it has to be segregated in terms of A and B, because now you hold 60% of 60, so that means that would be 36,000, and in case of B, 40%, that means 240. Now it's not very important uh, for an LLP to distribute compensation. It's just an obligation. I mean, if you really want to withdraw, you can withdraw, or you can also keep it as a part of an LLP. And the same goes to for a company as well. That means now, once this 36,000 has been distributed to A, this would again get taxed, personally taxed in the tax bracket. But it has been treated as an expense in case of the company's financials, right? So there has to be what you can say is a calculation on the basis of whether withdrawing would make more sense or just keeping it in the LLP would make more sense without distribution, right? In case of a public company, that is what they're saying. It cannot exceed 11% of the profits. Okay, so that's the restriction. Exemptions enjoys many privileges and exemptions. No such privilege. All it means to say there's a lot of regulatory requirements in case of a public company. In case of a private company, not much. Okay. Statutory meeting optional. Out here it's compulsory. Right. So this was the first part of the session. I will try to restrict my discussion and probably will get on with another case study on trying to look at a real startup and try to see how the companies actually moved across various stages of business cycle in the next lecture. All right, so I'll see you again. Bye.